Nothing in this video should be taken as financial advice. The problem is not to find the answer, it's to face the answer.
You just need as a system to decide. And then the last point, which is a real challenge, we know this is a challenge in all industries, is the need for an open trading and financial system so we get the flows there.
An open financial system. What does that sound like? An open financial system and an open trade system that everyone can work with, everybody can use, everybody has access to.
Let me just say a couple of words on the financial side, then I will stop. We had an industrial revolution. We had an entirely new financial system that funded that. We had a new monetary system with the gold standard for cross-border capital flows. We had fractional reserve banking, a change to the role of the Bank of England and others, which traded the capital. We need something, and we're in the middle of something on that order of magnitude with the financial system.
Mark Carney is telling you that an entirely new financial system is underway. This is a man that spent his entire life in central banking, from the Bank of Canada to the Bank of England. The world is undergoing a transformation.
Could be impaired and could lead to disorderly market circumstances. We certainly have the tools to address the issue.
The central banks are ready to print. Whatever comes, whatever happens, they have the tools, which means they will print as much money as possible to get out of the situation. The problem is the situation is because of the money printing.
And then he goes down to say that the total price for all of the data, like if you wanted, I guess, is 300 terabytes of data, would be $50 million. Data can also be prepared, especially based on location and ethnicity. The cost for...
If 23andMe fails to pay a $50 million ransom, over 300 terabytes of individuals' genetic information will be made public. My sisters use 23andMe, so my own genetic makeup could potentially be leaked and used by data brokerages. This is why when Incogni asked to be a sponsor of the show, I agreed because it's a service that I want to use. Incogni contacts data brokerages and tells them under the law you must remove Darren's information from your database. The databases are obligated to comply. But it's important to note that data brokerages will not discriminate against who they share their information with. It can be used by landlord, banks, employers, or even scam artists. Incogni.com/Darren. With this link, you'll get a special discount. You'll be able to help the show. I know many of you don't like sponsored content, but Incogni, as well as others, make this show possible. So please check them out, incogni.com/Darren. You'll receive a 30-day money-back guarantee.
Now, there was a decade after the global financial crisis when, that was less of a problem because you could borrow at ultra-low interest rates and that was not an issue. But now you're borrowing at much higher rates and you have weak growth prospects. So this is a difficult place for countries to be. There's a challenge, particularly for emerging and developing economies who have important development goals that they have to meet the climate transition. But I think it is an important time for governments to think about how they're going to pay for all these spending needs without relying as much as they did on borrowing.
The government is going to continue to spend until there's a catastrophe. You're already seeing it in the bond market. TLT is not even leveraged and it dropped like a stone. This is a symptom, and the government is not going to stop until it breaks.
What is troubling is the weak growth looking into the medium term. So we have growth projected at around 3% into the next several years, well below the average that we've had over the last couple of decades, which was around 3.8%. Second, inflation has come down, but the job is not done yet. You still have sticky services inflation, core inflation. It is going to be a bumpy road, and that's going to be a challenge for policymakers. And importantly, we live in a world of a large number of shocks. Geopolitical events, the conflict we're seeing in the Middle East, the consequences that could have for energy prices. Debt levels are at record high levels at the same time that we're in this higher for longer interest rate environment. So there is a lot for us to watch carefully And that could go wrong. And that's very important to keep in mind.
Geeta Gopinath, which is the chief economist at the IMF, is telling you there are black swans everywhere. With record high debt, record high inflation, our geopolitical situation is getting worse. She specifically highlighted energy. Right now in the Middle East, a lot of countries that are part of the oil and gas trade are looking at this conflict and picking a side. The U.S. is picking the other side. If there's trade embargoes or anything to that effect, you could see wild price swings, not only at the pump, but for all goods and services.
This is the most threatening and challenging geopolitical environment that I've ever seen. At the same time, the US is in its weakest fiscal position since World War II, with debt to GDP at 122%. Can America, can the West afford another war at this time?
I think the answer is absolutely. America can certainly afford to stand with Israel and to support Israel's military needs. And we also can and must support Ukraine in its struggle against Russia. And look, the American economy is doing extremely well.
Yellen doesn't know the answer to this question. She's always going to say the same things, that she supports whatever the government wants to do. She will not resist anything. The dollar bubble will implode. The warning signs have been flashing, and wars are expensive.
They're actual quantifiable risks. We need a new word for black swans. There's like 4 or 5 of them that used to be, you didn't even have to really, if it happened, we're all gone anyway, so you don't worry about it. But now they're actually something that are on your radar. Well, so is a pandemic, which was on your radar in Davos before anyone knew the word.
I would say the fiscal situation is very different from other cataclysmic events that we've suffered as a country. It's not Pearl Harbor. It's not 9/11. It's not COVID, where we did not see them coming. They were external shocks. The fiscal situation we have is one that's really clear. And
the debt is so high that there are no options for politicians. The option is to raise taxes and stop spending. That's never going to happen.
What this is all about.
Well, I can't talk about the specifics of anything. I think it's just an example of the pent-up interest in crypto. And we're hearing from clients around the world about the need for crypto. I mean, when you think about, I think some of this rally is way beyond the rumor. I think the rally today is about a flight to quality with all the, all the issues around the Israeli war now, global terrorism. And I think there's more people running into a flight to quality, whether that is in treasuries, gold, or crypto, depending on how you think about it. And I believe crypto will play that type of role as a flight to quality.
I agree with Larry Fink, except for the fact that he said treasuries. I think right now the world is soaked with treasuries. Everybody's bought treasuries and they're tired of them. I mean, the only way treasuries become more and more enticing is if the yield rises. When the yield rises, that means that people are dumping treasuries. So we're at a point where this Ponzi system is breaking down and it's requiring the Fed to print and control the yield curve. When they do that, it's not if, it's when they do that, you're going to see crypto and other assets explode because they're flooding the world with money. They're devaluing their currency. It's not that crypto's going up, it's that the currency is going down.
On that, we also, central bankers, the holders of currency, we need to move to the digital area, and we need to be ready to launch CBDC. For us, it's digital euro in relatively short order, so that we can make it safe and have a monetary anchor that has digital traits as well.
Keep in mind that the euro is the second largest currency in the world. The euro dollar system. The euro is the other half. The central banks have to be on guard. They have to be ready to dive into the crypto realm. Why? Because the markets are going to dive into the crypto realm with or without them. So when Lagarde says that she's got a euro ready for the crypto world, That's very telling. She knows that at one point this is going to become a reality. And when that happens, there's going to be digital euros that people can use in DeFi applications or whatever applications they want to use them in.
To 0.8, which is quite a dramatic downgrade and goes along with all the new pessimism that is emerging. But within that, there's something very interesting happening, and that is the growth of digital trade and digitally delivered services trade, which is growing at 8% per annum. Out of $32 trillion of trade, we've got 25 trillion that is goods, 12 trillion services. And of the 12 trillion, 4 trillion almost is digitally delivered services. So this is growing so fast. We're saying, what can we do to make sure that we foster this trade, that we make sure micro, medium, and small enterprises and women-owned enterprises that are the ones using this trade the most, that we remove barriers in their way and that we put a level playing field so that this trade can grow even more.
The World Trade Organization can see a pattern that digital trade has grew exponentially. Now, digital trade is a wide term, but what Web3 offers is digital trade. It allows ecosystems of digital trade to interact. So the WTO is seeing this as a net benefit and telling the other central bankers that this is a net benefit. Therefore, they're going to support things that follow the rules and follow digital trade and make digital trade more accessible to other people.
You get the 30% increase in treasury supply on long duration at a point where the Fed's not buying, the banks are not gaining deposits, the institutional demand isn't there. And that has very clearly put the folks back on the debt dynamics, the debt sustainability, and the fiscal debt and the cost of servicing the debt.
The central bankers are telling you that there's a huge problem with the debt market, yet the government keeps borrowing more money and issuing more debt into a debt market that they're telling you is there's a big problem in. So something's going to break, and when it does, what's going to happen? The government's going to force the central bankers to buy the debt, which is not supposed to happen. There's supposed to be a check and balance between both of them, but that's not going to happen. What's going to happen is the central banks are going to be forced to buy all of the debt. The debt market's going to implode, and the Fed is going to put it all on their balance sheet. Except that time, that's the big one.
But the other aspect, and this is the novel piece that Joyce pointed to, is we are seeing some pricing in of fiscal risks, which is usually unheard of when you think of the US market. You have a large amount of debt being issued at a time when you have quantitative tightening being done by central banks, at a time when Japan's rates have gone up, and therefore their demand for US treasuries are somewhat weaker. In that environment, what we're seeing is pressure on yields at the long horizon. Right? So right now there is a huge demand for cash, which is on the short end of it, but we're seeing a lot more volatility on the long end. And I want to take that to a kind of step back and make a broader point here, which is that if you look kind of around the world, this is particularly true of the US, but many other countries, we're seeing a looming mismatch between the spending needs of countries and the resources that they will have to pay for it.
US debt has already been repriced, as well as the debt has been downgraded from perfect rating to a less than perfect rating. Quote, we are seeing a mismatch between the spending of countries and the resources they have to pay for it. These are a bunch of central bankers telling you that it's the government's fault.
And the second problem that we're seeing in the market is there's a huge amount of action now happening because basically with higher interest rates, the prices for bonds, for credit, for all of your investment portfolio get depressed. And that's something that will work its way through the banking books for some time. There's a non-bank financial intermediation that is a new risk, but it's a regulatory terra incognito for most of the banks and regulators. We'll see how stable that is. My question would be, is it systemic? And last not least, My biggest concern is all the areas that didn't suffer any problems in the last financial crisis. Complacency only breeds where there is no problems. And if I look at the areas where there was a big impact from the last financial crisis, those areas that are suffering and likely to suffer in the future are in particular, again, housing markets in those economies and sectors that didn't have a problem last time around. Commercial real estate is the problem now as opposed to real estate or mortgages in the last time around. Mortgage markets in New Zealand, Sweden, Canada, Australia, the Netherlands have really been largely spared last time around. Look at the decline in prices there. So I go by this symptom. If it wasn't a problem last time, it's likely to become a problem now. And with that, keep your safety belts on, because trying to land this plane safely is required that you go through rocky air. Thanks for your attention.
You don't typically hear central bankers say, put on your seatbelts, we're headed for a rocky landing. Well, commercial mortgage-backed securities are down 20%. This is another bedrock of the banking system. Commercial mortgage-backed securities and treasuries are both tier one assets. They're used as collateral for banks. Both of these assets have been extremely volatile. So how do you have a system that's pegged to these assets that is absorbing all this volatility? There is trouble in the banking system, and it hasn't surfaced yet. I would argue that money is going to rush out of the old system and into the new. As the world we live in is so unpredictable, the ability to learn and to adapt to change is imperative, alongside creativity, problem solving, and communication skills. Thanks, everyone. I hope you enjoyed the show. Please take a moment to like and subscribe. If you enjoy content like this, please consider joining my Patreon or my Ghost site.